Is the Fed trying to save the housing market crash or trying to make it less severe than what a lot of experts expect it to be? In today's video, we're going to talk about how the recent Fed hike affects the housing market. Now, I'm making this video right after Jerome Powell's speech talking about the Fed's rate and just the economy and inflation as a whole. And so if you all don't mind, please be sure to like this video, comment down below your thoughts on the recent Fed hikes and its effects on the housing market. And also be sure to subscribe to this channel for some awesome recent news and content around the economy, around mortgages, and the housing market. Now, the Fed's rate is not completely tied to mortgage rates, so mortgage rates aren't completely impacted by the Fed's rate, but it does heavily influence it. What influences mortgages more than anything is inflation. And recently, the CPI report came out that inflation wasn't as high as most people projected. It was around 7.1%, which is still extremely high, but most experts predicted it would be around 7.3%. And since the rate of inflation have been declining over the past couple of weeks, mortgage rates have been decreasing also. And recently, over the past week, we actually saw an increase in mortgage applications. And so yes, inflation is still high and the Fed is still increasing interest rates, but looking at the pace at these increases truly affects mortgage rates. Because over the past 4 Fed meetings, the Fed had been increasing the Fed rate by 75 percentage points or basis points. And so basically it's 0.75%. But over this past meeting, this meeting that happened today, they only increased it by 0.5%. 50 basis point. And so the pace is not as high as it used to be. And because of that, actually the Dow Jones Industrial Average still dropped 600 basis points because of these recent news. Because yes, the Fed is still increasing borrowing costs and they're trying to make it impact different sectors like the housing market and the stock market in order to bring inflation down. Some experts believe that the Fed just increasing the Fed rate by 50 basis points and slowing down the pace at which they increase is good for the economy because yes, they looked at the CPI report, they saw the pace wasn't as strong, and so they're trying to slow down their pace, and this is good for mortgages. Now, the Mortgage Bankers Association believes that interest rates will range or be around 5.2, 5.3% next year. And so that's almost 1% lower than what it is right now. Now, with what the Fed is doing, of course, they're trying to impact the housing market. And with inflation running high, they're trying to bring inflation much lower. And so by mortgage rates increasing, that will put less demand on the housing market. And so builders will most likely not build as many properties as they used to, and they're currently doing that right now. They're not buying as much land. They're taking on specific properties at specific price range. Maybe they already have a buyer in place, but the demand for new construction homes are declining. And then on top of that, because home builders are not buying as much materials or investing too much in labor, that puts other sectors of the economy down, which reduces inflation. So now these materials, their prices are not overvalued anymore. The labor market is not overvalued. You're not buying as many washing machines or technology to build these houses or to put things in these houses. And so you see how housing market is a great indicator. It's a great sector to attack first because it affects so many other sectors of the economy. But recently, we have been seeing declines in mortgage rates. As I stated before, mortgage rates were around 7%, over 7% in October, and now they sit at low 6%, even in some areas in the 5% range. And so I think now this is the time for home buyers to make those offers. Yes, start applying for mortgage applications because now we're seeing the benefits of what the Fed is doing in the housing market because yes, the mortgage rates are going down. And so now it's becoming a little bit more affordable for homeowners. And on top of that, home prices are beginning to decline. Yes, they are still at all-time levels. They're still extremely high. But right now, mortgage rates are decreasing week by week. Like over the past 4 weeks, there have been decreases in mortgage rates. And then on top of that, home prices, the median home price is declining. So yes, we're finally feeling the benefit of what the Fed is doing and just taking advantage of this recessionary period that we're entering into, because a lot of people predicted, and I still have a video coming out about stagflation, that home prices will still remain high, and at the same time we will have higher mortgage rates. But most likely, hopefully, they're not as high as they were in October. A lot of experts now, like I stated before, from the Mortgage Bank Association, they believe that mortgage rates will be around 5.2%, which is doable, which is actually not normal. So it's actually pretty normal for mortgage rates to be around 5.2%. And so I think this is good for homeowners, because as more of the effects of what the Fed is doing of bringing inflation down impacts home prices more and more, it will become more affordable for people to purchase and make offers on homes. Now, there's still a possibility that mortgage rates are still going to explode in 2023. Yes, they may drop a little bit, but there's a possibility, most likely it will go up, because the Fed rate is still going to be increasing in 2023, right? It may be by 25 basis points instead of 75 or 50 basis point. And so mortgage rates will still creep up a little bit, and you still may even go over 7.5%. So I don't have a crystal ball on everything. I'm just presenting the news. Right now, mortgage rates have been decreasing since October. It can continue to decrease over the winter months and into next year, early next year. But with the increase of rates by the Fed, even though it's at a slower pace, that can still impact mortgage rates to go up. Now, I just want to be crystal clear of what I'm saying, and I know this may be a confusing topic with just the different vocabs and just understanding the economy, and I'm still learning every single day about this. But essentially, mortgage rates are not directly tied into the Fed rate. They're mostly tied into inflation. So as inflation goes down, mortgage rates go down. But the way that the Fed influences mortgage rates is that the Fed rate influences inflation. And so as the Fed rate goes up, that increases the borrowing costs of other sectors of the economy, which is in the inflation report. And so as these different sectors go down in value, go down in price, that brings inflation as a whole down, which will bring mortgage rates down. And just even alone, the Fed rate can just influence just the market and the sentiment of people, as people see, oh, Jerome Powell raised the rates by 50 basis points. Okay, I thought it was going to be 75 basis point. Maybe as a bank, I'm not going to increase my mortgage rates this much. Maybe I'm just going to increase it by that much, or even decrease it a little bit. Because like I said earlier, yes, even though the Fed rate has been increasing, over the past couple of weeks, the mortgage rates have been decreasing. And so hopefully we can continue that trend to next year. But of course, I don't have a crystal ball. And so next year, you can still see rising mortgage rates because the inflation goes up, or because the Fed is still increasing interest rates and people are getting influenced by that and saying, oh no, the Fed rate is now at 5.5%. I'm going to increase mortgage rate as a banker, or things of that nature. So either one can happen, but I think over these past couple of weeks, we have been seeing a stabilization in mortgage rates and even a downward trend in it. And some experts are believing that it's going to remain between the 5 and 7% range. Now I want to talk about home prices. Will home prices decline because of the recent Fed rate, or just an inflation report, or just as the economy as a whole? Will home prices decrease? Well, the median home price is still extremely high, but we have been seeing reports or suggestions that the median home price is decreasing day by day. Just a little bit, but not at the level that the Fed actually wants it to be, but it's still decreasing a little bit. Now, what can you do as a potential home buyer? I say number one is still apply for mortgages, right? As we have a slowdown, maybe there'll be less competition, even though there's a low supply of houses. Not as many people buying houses earlier this year are going to buy houses next year, right? And so on top of that, just make sure you stick with your budget, ask for lower than asking price, ask for sellers to pay closing costs. I was reading online that 90% of all current offers on properties contain these contingencies of the seller either paying closing costs or paying points to bring the interest rates down. And so make sure you do that in your offers, and also stick to your budget, like I said, and don't rush into anything that you can't really afford. All right, I hope you all enjoyed this video. Be sure to like, subscribe, comment down below, and let me know your thoughts on the recent Fed hike. All right, thank you.